Hello and welcome to the Freedom Finances Show. My name is Bradley Valentine and I'll be your host today. It is Friday, October 18th, and today we're here to talk about timing the market. We've discussed why timing the market can be difficult and essentially impossible, but today we're going to talk about the only real method in timing the market, and that is investing early. So let's dive into some numbers and find out why investing early is the true possible method of timing the market. Many people look at a good stock or an investment and think, man, if I had just invested a couple $1,000s into that 5 years ago, I'd be rich. It'd be amazing. And while this thinking is flawed, it is accurate. Your goal shouldn't be to invest at the right moment, but instead to invest early and watch your profits grow. To make our point, we are going to look at some major stocks that anyone can invest in today without having to worry too much about risk. So, very first, let's start with the S&P, and then we're going to move into some funds. We're going to look at a couple different time frames, all of them starting at the beginning of their respective years. To start, the S&P 500 index, which is an index of the top 500 companies in the United States, is sitting at $5,860 today approximately. Looking back at the beginning of the year, the index sat around 47.45, which is about a 23.4% increase today. However, at the beginning of 2023, the S&P sat at 3,853, which means that in less than 2 years, the increase is over 50%. So let's see how you could make money off of this index. Let's look at an S&P 500 exchange traded fund, or ETF, which bundles stocks in the S&P for you. We'll start with Vanguard S&P 500 Index, otherwise known as VOO. So VOO is a very popular index fund that's kind of blown up over the last couple of years, and a lot of people talk about it. So I figured it'd be a great opportunity to talk about it today and see how much money you could make off of it. Today, VOO sits around $537. At the beginning of this year, the fund sat around $433, and at the beginning of last year in 2023, the fund sat around $353. Now, if we were to do just some simple math, we could see at the beginning of 2024, the fund has increased to about 23.7% to today. And since the beginning of 2023, the fund has increased about 52%. So if you're paying attention, you'll see that these percentages are extremely close to the S&P 500. Okay, now, if you take that money, let's say you invested $1,000 into the fund in 2024, you would now have around $1,237. And if you invested $1,000 into the fund in January 1st, 2023, you would now have $1,520. Now, VOO is just one ETF out of many that you can choose from, and I'm not necessarily saying throw all your money into VOO today. I just want to show the example of what an exchange traded fund, especially one of the S&P, could do for you the earlier you invest. You're going to see similar trend for other funds, but let's move on from indexes and ETFs and let's look at something that has a little more risk, which we're looking at individual stocks. The first stock we're going to look at is Apple. As of recording this today on October 18th, Apple is the largest company in the world, worth over $3.5 trillion. So that's why I'm going to Apple. It's a huge company. Everyone knows who they are. It's extremely, extremely valuable. Now, Apple is probably a good investment for most people, but the fact that it is a solo stock means it is inherently more risky than something like an ETF like VOO, which we just discussed. However, because of that inherent risk, we can see an increase in potential growth. Today, Apple is trading around $235 per share, and at the beginning of the year, it was trading around $187 per share, which is a 25.5% increase. At the beginning of 2023, Apple was trading at $130 per share, which is an 80.4% increase. Now, We're going to go back just one more year to the beginning of 2022. On January 1st, 2022, Apple was trading at $177.83 per share, which is an increase of 32.1% today. Based on what I just said, you may have noticed that Apple actually had a down year in 2022, which is an important part of our discussion today. But before we get there, let's see how much money you would have if you had just invested during these time frames. Once again, we're going to use $1,000. So if you had invested $1,000 on January 1st of 2024, today you'd have around $1,255. If you invested $1,000 on January 1st of 2023, however, you would have a much greater profit with your total sitting at $1,803. And finally, going back to January of 2022, if you had invested $1,000, you would now have about $1,320. So all three scenarios give you a profit. However, the best profit was to invest on January 1st of 2023. But here's the thing, there's really no way to know that. There would be no way to know that January of 2023 is better to invest if it's 2022. I'll wait till January. So unfortunately, you just have to go with the mindset of I need to invest early and I need to invest often. That's what's best. Now, you may be thinking that I may have just proved myself wrong, but remember, even if you had invested 2.5 years ago, while you wouldn't have made as much money as investing just a year later, you still would have had a 32% increase, which is a pretty strong profit margin. It's also important to remember that because Apple is just one company, it's an individual stock and it's more risky and inherently more volatile. This means bigger swings in gains and bigger swings in losses. Okay, so let's look at one more company and one more stock, but instead of a growth company or a growth stock like Apple, we're going to look at a dividend stock. So Coca-Cola is a dividend king, which means that for the last 50 plus years, it's been offering a dividend to those who invest. Now, if you don't know what a dividend is, it's just a payment for investors who hold the stock. Usually, dividend stocks are for companies that are well established and don't show quite as much growth. However, some dividends are offered by growth stocks as well. Today, Coke is trading for around $70. January of 2024, the stock was trading for around $58.80, which is nearly a 20% increase. January of 2023, the stock was trading for $63.56, which is only an 11% increase. Now, we go back one more year. In January of 2022, we will see $59 is what Coke was trading at, which for today would be a 20% increase. So, once again, the best time to have invested would have been as early as possible, as we'd see a 20% return if we had invested in 2022. However, it is important to note that unlike other stocks, we're not just looking for gains when we have a company like Coke that gives dividends. This is very important because investing early really matters when it comes to dividend stocks. So we're looking for dividends, which means we're looking to get paid just to own the stock. So how much would you have had if you invested over the last few years? Let's go ahead and take a look. If you invested $1,000 at the beginning of the year, you would have around $1,197 today just from growth. Coke pays a quarterly dividend, and for the sake of the scenario, we'll just assume that you've had 2 dividend payments in 2024. That means you would have an extra $16.50 from dividend payments, which means you would have a total of $1,213.15. That means your growth really would be closer to 21% than the original 19% from that investment of growth in stock price. If we plug in the same numbers for January of 2023, the profits can be realized completely different. The growth of the stock of $1,000 would only be worth $1,106 today, but you would also have gained another $50 or so in dividends bringing your profits total closer to $156, which is a 15% gain instead of the 10% gain from stock growth alone. So we're almost done with Coke, but let's bring it back one more year, and now we're going to see some really good gains. A $1,000 investment in January of 2022 is worth $1,196 today, good for about a 20% in gains. But the addition of an $84 in dividends gives us $1,280, which is nearly a 28% growth. You're going to start seeing that the longer you have a dividend stock, the more growth percentage you're going to see, even if the stock itself isn't growing too high in price, and it's those dividends that really start paying off. Now, at the same time, however, you might be thinking, well, it's great gains for Coke that we've had, but even if you invested in Apple a couple years ago, it would still be better. Well, this is true, and the great thing about Apple is that they offer a dividend too, albeit not quite as much as something like Coke. But there is a reason why Apple is the top company in the world, and it is because of their amazing profits. Of course, with amazing profits, we realize amazing stock prices and amazing growth. But Coca-Cola offers something that Apple and other companies do not offer. Coca-Cola has a 0.51 beta, meaning its risk and volatility is lower than that of the overall stock market. Apple, on the other hand, has a 1.24 beta, meaning it has a higher risk and volatility of the market. Now, both choices, whether you pick Coca-Cola or Apple, are good choices, honestly, and if you had invested in them, either way you would see some very good gains. Now, I'm not going to tell you which stock is the best stock to pick out of those two. It's up to you. What I can tell you to do, though, is investing in those stocks earlier and instead of waiting is going to be better. And even better, invest in both of the stocks if you can afford to do so, because you reduce your risk and your volatility when you have a diverse portfolio. So it's definitely a good choice to have both. Let's break down some principles and idea that we've learned today just from looking at the history of some of these stocks and funds. And we're going to go ahead and start with the obvious, which we've talked about before. We started off the podcast this way, and it's to never try to time the market. Anytime you try to time the market, you're going to be wrong. The only real way to time the market is to invest early and hold. When you do so, this strategy will give you more time to realize profits. Second, investing early doesn't just mean you get to realize more profits. It also gives you the opportunity to gain funds from things like dividends or other certain stocks. Next, when we use S&P 500 ETFs or even mutual funds, where investing is very close to matching the performance of the S&P, you lower your risk, but likely also lower your potential gains. Growth stocks like Apple are great for gains in your portfolio. While you need to invest early and often to realize these gains, you also minimize your risk. Furthermore, growth stocks risks are reduced when diversifying your portfolio with other stocks, such as a dividend stock. And finally, dividend stocks benefit greatly from early investments, as you can sometimes gain growth and profit, but more importantly, you can gain dividends which you can use to reinvest into the same stock or other stocks for more growth in the future. My goal today was not to make you envious of all the potential gains you may have missed out from not investing, but instead to teach you that investing early and not focusing on timing the market is where you're going to achieve. So if you're asking yourself when you should start investing into your retirement, the answer is now. Don't wait to time the market, because the best time is right now. Invest early, invest now if you have the ability to do so. I recommend researching some exchange traded funds or ETFs, research some growth stocks, dividend stocks, and more. Start your investing to build your growth now. Thank you all so much for listening today, and I hope you learned at least one thing that increased your financial literacy and will help you with your financial freedom in the future. Once again, my name is Bradley Valentine, and I hope you have an amazing day.